Assalamualaikum, I am Asmaa Binti Muhammad Azhar, 1180732. I'm from KME1. So today I would like to present my investment portfolio. With the funds of 100,000 ringgit, I chose to invest in 5 stocks from different industries, which are meats, binary, Kobe, IHH, and gas. In my portfolio, each of them are weighted 20%, so the total weighted for these 5 stocks are 100%. The 5 Sharia compliant stocks are selected based on the company potential industry, means their potential of future growth, and also based on the technical analysis like the stock is currently uptrend, etc. So we will see the return performance for 1 year from 4 January until 31 December 2021. At the end of investment, we will know either the returns are as my expectation or otherwise. Okay, so here is my 5 stock that have been selected. Okay, so we go to next sheet. Okay, in this section, we use 1 year historical data for all stocks from 4 January until 31 December 2021. So then we can calculate the return for each stock by using this Excel function. Okay, for example, okay, look at the Miss Berhad. Okay, for example, this Miss Berhad, okay, to get return at 6 January, I took price at 6 January minus price before, which is price at 5 January over price 5 January times 100. So I got 1.37% of return, and then I just drag to all rows and columns to get the return data. The same goes the calculation, okay? For expected return, it is just average from all the return data, and then we drag it to other stock to get expected return for each stock. Okay, same goes to standard deviation and variance, which is enter from the standard deviation and variance. Okay, click the data, so we got the value of each stock. As the result, we can see the highest expected return and standard deviation is Kobe stock, 0.983 expected return, and the standard deviation is 5.732, which means Kobe will have high profit and also high loss. This is correspond with the concept of high risk, high return. Okay, to get correlation and covariance function for each stock, we just put the formula using this Excel function, then we can get all this data. Okay, now look at the data. Okay, this all the data. Okay, which taken from pinbox.com. It represents how much risk involved. Based on this data, all of the shares having a positive beta. Okay, as you can see, all of these are positive, means that it has a positive relation to market movement. Other than that, risk-free and risk premium are taken from Market Risk Premia website, which 3.59 and 3.46 respectively. Okay, for KPM, the capital asset pricing model describe the relationship between systematic risk and expected return for asset. Get portfolio return 4.86328 and portfolio beta 0.369. Okay, this is variance and covariance. Use solver to get efficient quantity graph. Quantity is a graph that plots the expected return on a portfolio of investment on the y-axis. Okay, this is expected return, and its risk as measured by its standard deviation on the x-axis. So the x-axis is standard deviation. So it demonstrates the risk and return trade-off of a portfolio and help us visualize the efficient portfolio, the global minimum variance portfolio and inefficient portfolio. Okay, from here we can see unit risk can be eliminated through diversification. We need to only worry about systematic risk. Okay, so the efficient frontier graphically presents portfolio that maximize return for the risk assumed. Return are dependent on the investment combination that make up the portfolio. So any portfolio that falls below the efficient frontier is an inefficient portfolio because it is generating lower return per unit of risk. Such a graph is called the efficient frontier. So the point on the efficient with the lowest standard deviation is called minimum variance portfolio. We can see here the minimum variance portfolio at this point. Okay, and then for stock investment performance, okay, as my early plan to invest each stock weighted 20%. Okay, the total cost, the total cost is 100,000. Okay, the each stock having profit, and we can see the highest return is Kobe 662.9. The total gain 150,463.1 cents. We know that from this we managed to gain revenue and minimize risk using the investment portfolio. Okay, now we go to next, Sharpe, Triennial and Alpha. Okay, we know that Sharpe ratio use portfolio standard deviation to adjust the portfolio return. Usually, any Sharpe ratio greater than 1.0 is considered acceptable to good by investor. Okay, here we can see Sharpe ratio is greater than 1, which is 1.48. So it is considered acceptable to good by investor. The Triennial ratio is a risk or return measure that allows investor to adjust a portfolio's return for systematic risk. Okay, a higher Triennial ratio result means a portfolio is more suitable investment. Here we can see my Triennial ratio 4.89 shows this is suitable investment. Last one is Jensen Alpha analysis. Measures is one of the ways to determine if a portfolio is earning the proper return for its level of risk. If the value is positive, then the portfolio is earning excess return. In other words, positive value for Jensen Alpha means a fund manager has beat the market with their stock picking skills. Now we can see Jensen Alpha is positive 1.61928. Means that this portfolio is earning excess return. Okay, and then the next thing is all the historical data. Okay, so the overall is this portfolio investment is in good performance. A well-diversified portfolio is the best bet for the consistent long-term growth of investment. That's all from me. Thank you.